a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about low volatility and minimum volatility stocks and ETFs that have seen some interest from investors as stocks have been on a roller coaster ride lately. Investors have been trying to decipher the impact of President Trump's tariff plans. So the S&P 500 index is down more than 10% since hitting an all-time high in February, on February 19th, and it is down about 3.5% year to date. And the CBOE volatility index, which is also known as the fear index, that has surged lately. And there are some recent economic reports that have raised fears of stagflation. And though I think it's too early to use that word. So, but basically, stagflation is when growth slows while inflation remains elevated. And we have seen that inflation has remained sticky. It has remained sticky above the Fed's target level. And then stretched valuations of particularly of mega cap tech stocks that have also unnerved investors. Now, these low volatility and minimum volatility ETFs, they will hold companies with consistent revenues and earnings which are more resilient to recessions and other macroeconomic shocks. They will perform well. They tend to perform better during stock market downturns, but they will underperform during stock market rallies, particularly during strong bull markets. So we will take a look at three most popular minimum volatility and low volatility ETFs, which are quite different from one another in their approaches. So the first one that I'm highlighting is by iShares USMV. So this says minimum volatility, and this is the most popular product in this space with 24 billion in assets, and it has seen inflows of about 600 million this year itself. So it holds 180 stocks, and overall it tries to construct a portfolio which has lower volatility relative to the broader market, quite reasonably priced at 15 basis points. Let's go to the quote page on Zacks.com. You can read our research report articles, and using the link, you can go to iShares webpage and see what it tries to do. So it basically uses optimization, and in addition to volatility of individual stocks, it also considers correlations between those stocks, and then tries to construct a portfolio which has a lower volatility relative to the broader market. Let's take a look at the holdings. So Berkshire, which is trading at its all-time high, is the top holding in the portfolio currently. Then you see other defensive stocks like Progressive, Republic Services, T-Mobile. And if you look at the sector exposure, information technology is still the largest sector, about 25% of the portfolio, financials at 17%, and then you have healthcare, consumer staples, and industrials and utilities. And just to compare it with sector exposure of the S&P 500 index, you will see that S&P 500 index has almost 31% exposure to information technology. So your lower volatility ETF will have much lower exposure to IT and much higher exposure to defensive sectors, including consumer staples, industrials, utilities, etc. Now, the second ETF which I'm highlighting is by Invesco. The ticker symbol is SPLV. So this has a simple methodology, just the least volatile of the S&P 500 stocks, the 100 least volatile of the S&P 500 stocks. This has 7.6 billion in asset and slightly higher expense ratio of 25 basis points. Let's take a look at this ETF and what it holds. So, in this, you will, because you will get more defensive exposure. So, information technology is quite low, just 5% of the portfolio, and more boring sectors, more low volatility sectors, financials, utilities, industrial, consumer staples, these get much higher allocations in the portfolio. Berkshire Hathaway is the top holding in this CTF as well, and also because the stock has done so well. Then Coca Cola, Marsh and McKinnon, and Republic Service, these are among the top holdings in this ETF. The third ETF that I'm highlighting is the least expensive of these, and this is slightly smaller too compared to the other two, and about 900 million in assets, 12 basis points expense ratio. This starts with the Russell 1000 index, and then it holds the least volatile stocks from each sector. So it goes and looks at least volatile stocks within each sector, stocks with lowest volatility in each sector, selected and weighted by the inverse of their volatility. And this is the portfolio that you get by that methodology. So top holdings are Walmart, Colgate, Republic Service, Duke Energy, etc. You will see that in this also information technology exposure is much lower, and you get much higher exposure to financials and then defensive sectors like industrials, utilities, staples. Now, on the next slide, I have the comparative performance year to date versus the S&P 500 index. So all these three ETFs, they are up between 5% and 6%, and they all have outperformed the S&P 500 index, which is down more than 3% year to date. Then I also took a look at the long-term performance, the 10-year performance of these three ETFs. And as I had mentioned earlier, they tend to underperform the broader index during strong bull markets. And since all these three have much lower exposure to information technology, they all underperformed the S&P 500 index over the last 10 years because mega cap technology stocks led the market, and they did so well over the past 10 years. And out of the three, the Spider product did quite well. And the Invesco product, which holds the most boring, most least volatile stocks from the S&P 500, that was the worst performer of the three. And as I mentioned, also that they tend to outperform when during market downturns. So we all remember that stocks had a terrible performance in 2022. So S&P 500 index was down about 19% in 2022, and all these ETFs had done really well in 2022 compared to the broader index. And at that time, the Invesco, the most boring of the three, that had done quite well, most defensive stocks, and that was down about 5%, but the other two had also done quite well. So basically, if you expect stock market volatility to continue, then these ETFs are good places to hide in while still having exposure to the stock market. Thanks for watching. Make sure to check out zax.com/ promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything. And I will see you next week.